The market is again in a state of absolute shock. Amazon just reported earnings and the algorithms are selling. Why? Because of one single terrifying number that Andy Jassy just dropped on the conference call, $200 billion. That is the capital expenditure guidance for 2026. To put that in perspective, that is not just a big bet. That is the GDP of a small country. That is the single largest infrastructure spend in the history of modern capitalism. A massive 56% increase from last year. Wall Street sees this as cash incineration. They see a company burning the furniture to stay warm. But here at Scope, we see something different. We see a company building a moat so wide and so deep that no competitor will ever cross it again. Is this the end of the efficiency era or the beginning of the biggest monopoly breakout we have ever seen? Let's break it down.
First, zoom out. You are frustrated, and I get it. While Nvidia and Microsoft have been printing all-time highs, Amazon has been dead money. Look at this chart. The market is paying a premium for immediate AI monetization, but they are punishing Amazon for being in the build phase. The stock is lagging the Magnificent Seven because Wall Street hates uncertainty. But this divergence, that is our opportunity. Here is the smoking gun. This is the number that terrified the algorithms. $200 billion in capex. That is a 56% increase year over year. The consequence is brutal. Free cash flow didn't just dip, it collapsed. It fell 71% to just $11.2 billion. If you were hoping for a dividend or a massive buyback, forget it. The bank is being drained to build the machine. But stop looking at the cost and start looking at the growth. This is the most important slide in the deck. The tech recession is over. AWS revenue hit $35.6 billion, accelerating to plus 24% growth. This is the fastest growth rate in 13 quarters. The era of cloud optimization is dead. Corporate America is panic buying AI capacity, and Amazon is capturing that demand. How do they afford a $200 billion war chest? With this hidden weapon, advertising. This segment quietly generated $21.3 billion, growing 22%. Listen to me closely. Amazon's ad business is growing faster than Google search. This is pure high-margin profit that effectively subsidizes the entire AI build-out. They can outspend everyone else because this cash cow pays the bills. And here is the sleeper hit of the quarter. For a decade, international was a money pit. Not anymore. International sales exploded plus 17%, outpacing the US. We went from a loss to a $1 billion profit. The global drag has officially become a global tailwind. This proves the Amazon model works in any currency. We always look for the efficiency gap. Look at these lines. Revenue grew 14%, but fulfillment costs only grew 10%. That gap, that is operational leverage. They are selling more stuff, but spending less to ship it. This confirms that their regionalization strategy is working. They have built an inflation shield. So why is the stock down? It's the guidance. Management guided for Q1 operating income between $16.50 and $21.5 billion. That implies a drop from Q4. We are moving from the year of efficiency into the investment valley. Wall Street hates the dip, but this is the cost of doing business when you are launching Project Kuiper satellites and building data centers. But let's look at the blueprint. Where is that $200 billion going? It's going into 3 modes. 1. Custom silicon. Their Trainium chips are already sold out through 2026. 2. Project Kuiper. They are building a global ISP in space with gigabit speeds. And 3. AI factories. They aren't just renting servers. They are building the physical toll roads for the AI economy. We have seen this movie before. Look at 2016. Amazon crushed its own margins to build fulfillment centers. The stock lagged. Everyone panicked. And then, the stock tripled. We are in the exact same cycle, just with bigger numbers. CapEx today equals moat tomorrow. To be fair, the risks are real. First, FCF destruction means no near-term capital returns. Second, science projects. Project Kuiper is capital-intensive and risky. And third, valuation risk. If profits stay flat while they spend, the stock looks expensive. But the bull case is stronger. We have the trifecta: infrastructure dominance with chips and cloud, an advertising cash cow growing at 22%, and the massive reacceleration of AWS at 24%. This is the buy signal. As long as the cloud is growing, the thesis is intact. Technically, we are at maximum pessimism. The RSI is oversold. The price has hit a major support floor. The bad news is priced in. The risk/reward has flipped to the buyers. So here is the verdict. We buy the builders. We sell the doubters. We are rating Amazon an aggressive buy on pullbacks. Ignore the free cash flow noise for the next 12 months. This is a long-term compounder. Thanks for watching Stock Straight.